चल अपन ये बता दे perp dexes, difference between perp dexes and the basically the coming of Hyperliquid and how it's changed the market.
So Perp DEXs and Perps on exchanges are practically the same thing. It's just that the Perp DEX is more of a decentralized format of the same thing. Uh, in in an exchange, we all know, everything works on the basis of order books. So what you're essentially doing is you're trading against the market maker, or you're trading against the opposite side of the trade. So for example, if you're going long on something, so let's assume that how Tony mentioned, right? Like if you're doing maybe like a 2x leverage, right? You put in $100 and you've taken a $200 trade, right? A 2x leverage effectively means 50% asset price falls, you're liquidated, right? It's very safe trade. No trader takes that, obviously. For them, it's usually 20x or nothing. But 2x is just for the sake of the example.
अब अपने यहाँ 50x वाले भी हैं, 75x,
Correct,
50x,
75x.
So, for the sake of this example, we'll consider 2x. Now, what happens is, in this particular case, uh, and the fundamental difference between uh, a spot market and a perp market is, so in a spot market, let's say you buy something for $100. How does it rise to $200? It rises to $200 because somebody is now willing to buy it for $200. That's how the price has gone up. So you bought something for $100 and that you sold it for $200. The remainder $100 has been created out of thin air, right? How has that been created? It's because an order has been matched now at $200 where somebody was willing to sell and somebody was willing to buy. That's how it works in the spot market. Now, a fundamental difference in the perp market is, here what you've done is, here you've not bought the asset per se. You're simply trading or speculating on the price of an underlying asset, right? You're not buying or selling that actual asset ever. Never do you own that particular asset, right? This is perpetuals. Futures are a little different. For those who trade commodities, they know that futures, you have compulsory delivery also at that point of time. Even in equity markets, in futures, you have compulsory delivery. But here, you're simply just trading the price, right? You're just simply trading paper and speculating on the price. So you bought something at $100, right? Sorry, you've put in $100 as margin, how Tony explained earlier. And you've taken a 2x leverage, and you've now bought something worth $200 on paper. You've not really bought the asset. Now, say the thing goes up in value. Let's say the price of the underlying asset was $1 when you started trading it, right? You bought $100 worth of it at 2x. So you technically bought $200 worth of the asset. And the price of the asset goes from $1 to $2. Technically, the price has doubled, right? But in this case, you effectively had twice the amount of money invested into the asset. So even though the price has gone up 2x, since you were trading not just with $100, but with $200 of worth that amount, so your net position currently is now $400, right? Out of that $400, $100 is what you've put in as margin. $300 is what you've effectively made, minus all charges, funding rates, everything that Tony described. Now, where does that $300 come from, right? In this particular case, it's literally been created out of thin air, right? Because here there is no asset being bought or sold, right? You simply speculated on the price. So where does that $300 come from? Now that $300 is going to come from a person who's taking the opposite side of the trade, right? So you were betting on the price going from 100 to 200, right? Somebody else was betting on the price going from $1 to 10 cents, right? So effectively what you are making is what somebody else is losing. How you have given $100 to the platform to trade, which is your margin. Let's call it the money that is required for you to sit at the casino table. The person on the other end is only going to make how much you've put in. So that's how it's essentially happening on an exchange, on a centralized exchange. You are making effectively what somebody else is losing, and your order books are essentially working like that. What happens on a Perp DEX is you are effectively trading against not a centralized, but a coagulated pool of liquidity, right? Which has essentially been aggregated. Their liquidity providers are there. Their job is nothing. Their job is just to provide stables, right? So on a Hyperliquid, there are people who provide their stables, which could be a USDC or a USDT. Let's say there's $100 million sitting in Hyperliquid, right? And Hyperliquid is obviously paying them an APY or a return or an interest rate, right? What is that $100 million being used for? Now, let's say, like I mentioned, there are people going long and short. Unlike an exchange where people are going long and short against each other, here in this case, people are going long and short against the pool. So when people are going long and short, one person can only make what the other person loses. But in certain cases in the crypto market, that might get exceeded. So you stand to make 100 in profit, but the other person only has 90 to put up, right? That differential $10 is provided by this protective pool of $100 million. So the only difference between an exchange and Hyperliquid is that on the exchange, this pool of liquidity is actually provided by the market maker. The market maker is essentially underwriting the risk of every order which is being done. On a Perp DEX, that entire thing is being underwritten by this liquidity pool, which is provided by decentralized liquidity providers. That is the only difference. Everything else is the same. The trading experience is the same. The only thing on Hyperliquid is everything is verifiable because everything is on chain. Every order which is being matched is actually being matched on chain. On an exchange, you don't know like whom your order is getting matched with, or at what price is your order getting cancelled randomly. The Oracle price which is coming in into the exchange is a complete black box. Like tomorrow, I can simply get up and say that the price of this asset should not be $1, it should be 50 cents, and suddenly everybody gets liquidated, even though the price of that asset is probably $1 on another exchange. On exchanges, it's a complete black box. But whereas on Hyperliquid, the prices are coming through Oracle price feeds, and Oracle price feeds are verifiable on chain. So every block the price feed is actually being is being verified. So those are sort of advantages of trading on Perp DEXs. We are still seeing Perp DEXs trying to build their sort of footing in the market that we are in today. But overall, I think Perp DEXs combined or just I'll just probably talk about Perp DEX. They probably just constitute 5 to probably 8% of the overall trading volume. Everybody still kind of prefers an exchange to do their trading. But exchange also have their own limitations. They have their certain limitations on for you to run API sort of trading strategies, which Perp DEXs allow you to do. So it's like it needs to be weighed out for the person who's trading. But yeah, Perp DEXs is nothing but exchanges with decentralized liquidity pools. That's it. It's very similar to a Uniswap versus another any exchange when it comes to buying a spot asset.
Well, one thing that is different is also the amount of. So, like you said, the limitations, right? That is a major play why people who want to go to Hyperliquid or Aster, if they would, is because they allow you to place large order books with high leverage, right? Which your sexes don't normally allow you to.
Correct, absolutely. Because sexes have their own risk control measures because they obviously have their own money to protect. Because they could be the they could be the ones who are the market makers for that particular trade, right? And they want to protect that $100 million of liquidity that they're probably providing to any or class or perpetual pairs. So yeah, it is the limitations which sort of limit people trading on exchanges. But yeah, still the volume is pretty low in terms because I think institutions still prefer trading on exchanges. I think it's because they don't want to go through that learning curve of trading on a Hyperliquid. But yeah, but the ones who actually get addicted to Perp DEXs just don't want to leave. And it's because what Tony just said, there are no bars and limits in terms of how much open interest you can sort of rake in. There are some limitations on total open interest because Hyperliquid also, even though it's decentralized, on multiple occasions has exhibited certain interference measures, right? Because in certain black swan events, they do interfere and close positions.
They have ADLs in place. Yes.
Yeah, because
hammer कर रहे थे जब
yeah, if they feel that somebody is going after their liquidity providers, they will definitely interfere.
Yeah, that is what ADLs are for. Actually, that is what ADLs are for. When they feel that that somebody's going for their liquidity provider, as you say, or somebody's really going and winning against the market. That's what happens is when you don't have a lot of short positions against a long or a long position against the shorts. That's what ADL does, right? It basically auto deleverages you and sort of either closes you down or
closes out positions. Exactly, cleans it up because there could be a certain situation where, for example, on a particular asset, a person is only short and there is no long build up on that particular asset, how do you pay the shorts? Because if the longs are not going to lose their money, how do you pay the shorts? The net shorts are going to be paid by the liquidity provider, because the liquidity pool is there to pay out the net position, either net long or net short, which is not being covered by, because on any given day you will never have a position where 100 traders, $100 is short and $100 is long, right? You at times you'll have $90 short and $100 long. So in that particular case, there's a $10 net long position built up. So if the market actually starts moving up, there won't be enough shorters losing money to be able to pay the longs. So in this particular case, the liquidity pool is the one that sort of steps in. They manage this with funding rates. So in a situation where the market is more towards the long side, you will often see that the funding rate changes and often becomes negative, because at that particular point of time, they don't want people to go long anymore. They want people to go short, right? So that the net liability gets balanced out. So, but again, for me, all of these measures exist. All of these interference measures will exist if you're trading with leverage. But if you're trading spot, there is no restriction. Uniswap contracts are immutable. Once deployed, nobody can change it. So if you're trading spot, just be happy. And if Uniswap has MEV risks, but if you don't want MEV risks, if you don't want front running risks, go trade on CowSwap. And all of those. So if you're trading spot, you can sit and chill. Otherwise, if you're trading leverage, you have to be very, very mindful. Like Tony mentioned, it's not just about gambling. There's a lot of analysis that you have to keep on doing on a constant basis, because trading is a job, investing is more of a hobby. Trading is a profession.
Yes, and this is something I tell everybody who tell me, I want to buy leverage, and I tell them, bhai, please don't leverage trade. You can't keep looking at your chart 24 hours a day. Don't do it.
हम ट्रेड कर रहे होते हैं, सुबह मैं 6 बजे भी टेक्स्ट करता हूँ तो टोनी उठा रहता है कि हाँ देख रहा हूँ मैं.
Trading is a profession.
That is my full-time job. I sit.
Trading is a profession. Investing is a hobby. You can still investing can be treated as a hobby or as a vocation. Trading cannot be. If you're doing trading as a vocation, you're losing money.
True, that's true. And that is the sort of people you look for, man. I mean, the market looks for these sort of people. कि यही आए पैसा lose करें, so traders make money. Dumb money, as we call them.